Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Amazing to be back with you again. Today, we're going to be talking about a metric that I came up with on X months ago, but I feel that it was time to reintroduce it to my YouTube audience. We are on a quest to spread the orange gospel to the masses, so to help me, please hit the like button and subscribe to the channel. The more people that we convince, the more our bags get pumped. It's a win-win, so thank you for your support, my dearest little captains. Now, in addition to convincing the normies to buy Bitcoin, we need to convince CFOs, board members, why you need to put Bitcoin on your balance sheet. I came up with this thinking, how can we frame the opportunity cost of not buying Bitcoin as it relates to labor hours? I was thinking, what is the most concise, best framework that we can give people running operating companies why they need to buy Bitcoin? And this is what I came up with. So to start, dear listener, I need you in your head right now to picture every dollar that you've ever earned as a capsule of your future life. Now, we all know that inflation drills little holes into those capsules and the drips are relentless. The implied time yield, ITY for short here, is the gauge that tells you whether Bitcoin is replacing the lost contents of that capsule faster than they leak away. So here is the intuition that we all know. Inflation steals purchasing power at a rate that we'll call CPI for simplicity's sake. And as Bitcoiners, we all know that Bitcoin grows purchasing power at a rate set by an open global auction for energy truth. If you subtract the first from the second, you discover the net speed at which your stored effort compounds into extra hours of free life. We're all buying Bitcoin to pull the future forward. We want to retire earlier, right? So a positive ITY means tomorrow's self will buy more living time than today's. A negative ITY means that you are sprinting on a conveyor belt that keeps sliding backward. Now, on its face value, this might not be that profound to you because you realize this is just talking about a real rate of return. Yes, but it is framing it as time, and that's where it gets powerful. So this presentation is going to unpack the very simple formula behind this miracle of Bitcoin, chart its behavior through the bull and the bear cycles, and prove why every CFO, pension trustee, and individual saver must treat the implied time yield as the ultimate hurdle rate. Because once you measure capital in hours rather than dollars, the debate shifts from whether Bitcoin outperforms to how many of your finite hours on Earth you will allow inflation to steal from you before you decide to win them back. Now, remember, the basic formula that I gave you is just the BTC return minus CPI for simplicity's sake. And then here is the algebra that turns the philosophy into a dashboard. And the result tells you how many additional units of purchasing power time you gained in a single orbit around the sun. Now, why does this matter? Because the CPI line measures leakage, the Bitcoin line measures the inflow. ITY is the net hydraulic pressure pushing resources back into your future. If ITY reads plus 50%, that means every dollar hour that you store today becomes 1.5 future dollar hours after accounting for prices rising at the checkout lane. If your ITY registers minus 10%, that means that you're running in soft sand, losing 6 weeks of purchasing power for every year that you hold cash. You could add this extra variable to a conviction multiplier. You could divide ITY by your honest probability of holding through both market euphoria and market despair. If you believe that you will never panic sell, your multiplier could equal 1. But if history suggests that you sell as a 50% drawdown capitulator, well, you could have the headline ITY and face that diminished reality. Remember, the market owes you nothing for weak hands. So with the formula decoded, the remainder of this deck will show how ITY behaved across the entire macro regime, why it surpasses every conventional real return metric, and how capital allocators can weaponize it as their primary hurdle rate. Master this equation and you master the tempo of wealth itself. ITY behaves like a heartbeat, each pulse created by a catalyst that tightens Bitcoin's float or expands its demand. The first major wave arrived in 2017 with that retail mania that was crazy. December 2017 will always go down as one of the most fun times in my life. It was an on-ramp explosion that shrank liquid supply supply and delivered 4-digit ITY. The trough that followed looked terminal at the time, yet it primed the next ascent because coins migrated to cold storage and holders upgraded their conviction. Second pulse began in 2020 when the halving cut the new issuance while global money printing accelerated. Microstrategy converted their idle cash into BTC, injecting a credibility shock that lifted ITY above 300% in a single year. Now that wave kind of crested. We met the liquidity drought of 2022 where rising rates and the exchange blowups that we saw forced all of the weak hands out. And then again, the Bitcoin supply consolidated into wallets that seldom move, setting the stage for the ETF-driven resurgence of the last couple years, as well as the post-halving melt-up of 2024 interplaying with the ongoing corporate adoption. So every rally, therefore, contains its own seeds of scarcity. Each crash redistributes coins to those least likely to sell, raising the spring tension for the next move up. The catalyst now extends beyond halvings and stimulus, nation-state adoptions coming, spot ETF inflows, lightning-enabled payment rails, and accounting rule changes are all tightening the screws. So the lesson is very clear. Negative ITY phases are temporal discounts granted to patient actors, and each new positive cycle outruns inflation faster than the last. As a Bitcoiner, when you begin to understand these rhythms, they let you decide whether to harvest the time dividend early or ride the next pulse to reclaim entire decades of future labor. So now we're going to be talking about ITY versus the legacy real yields, and this is where the rubber meets the actuarial table. 10-year tips auctioned this month cleared at a real yield of 1.7%, the Treasury's own confession that sovereign IOUs do not beat the drainage rate of inflation. I have some shadow stats numbers going in here, the shadow M2 monetary debasement inflation, which has gold in the S&P returns in the single digits, if that. Plus the S&P is just inflated by buybacks and margin expansion. But Bitcoin's implied time yield from 2020 to 2024 averages 111% per year real, an order of magnitude jump in the speed at which stored labor outruns inflation. So if you visualize these numbers as 4 lanes on a highway of purchasing power, tips creeps forward at a bicycle pace, the equities and the gold cruise in mid-gear, while Bitcoin ignites the afterburners, covering in 1 year what stocks need a decade to match in real terms. Now, I want you to remember that this is not just a volatility premium, it is a structural consequence of fixed supply, expanding global demand, and proof of work's thermodynamic moat. So for treasurers, chief investment officers, and everyday savers, the message is brutal in its clarity. You need to benchmark every capital allocation against the implied time yield of Bitcoin, or accept that you are volunteering to work extra years just to stand still. When the best state-sponsored bond promises less than 2% real, and a monetary network offers triple-digit real returns despite 2 brutal drawdowns, the rational question is no longer why Bitcoin. It is how small can my Bitcoin allocation ethically be while I still claim fiduciary competence. So now that ITY's supremacy is quantified, the question becomes actionable. What do we do with a metric that rescues labor hours faster than any legacy asset? These are the 4 realms where the ITY rewrites the playbook. Number 1 is Treasury Shield. Idle cash earns 4% in money market funds, but bleeds 3% if you're just looking at the CPI. So if you park that float in Bitcoin, you historically capture the triple-digit ITY even during stagflation, which means that you're turning your working capital deadweight into an engine of temporal alpha. And then it's also a capital budgeting compass. Classic hurdle rates compare the internal rate of return and the weighted average cost of capital, but you could replace them with an ITY adjusted internal rate of return. If a project's real yield cannot outrun Bitcoin's ITY, it literally destroys shareholder time value. And my conclusion based on that is that only the highest conviction moated projects clear an ITY hurdle, forcing the disciplined capital allocation and killing any vanity capex. Think about how you can use this to manage your own portfolio design in your risk buckets. The traditional 60-40 portfolio was engineered for 2% inflation and 7% nominal bond returns, but those were conditions that died in 2008. You could have a Bitcoin sleeve sized to match targeted ITY exposure, compressing duration risk and providing an anti-fragile offset that tips or gold could never replicate. And the result is that fewer assets achieve a real return target, liberating risk budget for innovation instead of just inflation defense. And then we got to take a look at the pension and endowment salvation. Because underfunded plans measure liabilities in wage inflation, ITY offers the only asset that compounds faster than that liability. A 5 to 10% BTC allocation, even haircut for volatility, can close multi-billion-dollar funding gaps within a single halving cycle, which is an outcome that actuarial science calls statistically miraculous, yet ITY calls routine. And once you calibrate every cash flow, project, and portfolio sleeve against the implied time yield, capital allocation transforms from guesswork into a race against entropy, one that Bitcoin by design keeps winning. So cast your mind back to August 11th, 2020, good old Microstrategy deploying $250 million of capital into Bitcoin, 21,454 BTC at $11,653 each. Skeptics called it reckless, absolutely, but 12 months later, Bitcoin closed near $45,000, printing a 1-year ITY of 302% against a 1.2% CPI. And then if you fast forward to today, Bitcoin's trading around $113,000 right now, and now that first tranche of Bitcoin is now worth $2.4 billion, which is an 869% nominal gain. So if you subtract the roughly 20% cumulative US inflation since 2020, the real uplift still exceeds about 840%, an average 60% real CAGR, or what we label a 5-year compounded ITY. So if you translate that into labor hours, if a shareholder's $10,000 paycheck represented 1 month of life in 2020, the same slice of the original tranche of Bitcoin today safeguards over 8 months of 2025 living costs, which means that time was literally manufactured from thin air via a ledger that never sleeps. So the counterfactual to this is instructive. Had MicroStrategy instead executed a classic $250 million share buyback at its August 2020 price, it would have retired barely 1.9 million shares, which is less than 2% of the current float, and it would have provided no hedge against CPI's wage erosion. So the Bitcoin alternative didn't just beat dilution, it injected temporal equity back into every remaining share. And a lot of people think, Adam, this is just word salad. You're crazy. Wrong. One decision by Michael Saylor condensed centuries of aggregate employee work hours into a half decade. And that is the power of benchmarking treasury choices to ITY rather than to normal accounting optics. And the next 2 sentences I'm going to say are the entire thesis. Any CFO still debating cash versus BTC now must answer a sharper question. Who on this payroll can afford to donate 840% of their future time to inflation for the sake of being comfortable with our balance sheet? We have all of these companies spending 99.9% of their time trying to just operationalize their business. Take 0.01% of your resources and buy Bitcoin and hold it. It's the best use of your labor hours by far. And if you don't believe me, why don't you do this? Look up the profits per employee of Strategy versus Walmart. It'll blow your mind. Up to this point, I have treated implied time yields like a blunt but powerful instrument, yet its real brilliance appears when you refine it into specialized lenses. ITYT could be the post-tax layer because every jurisdiction skims a different slice of capital gains. You could subtract the statutory bite and reveal how many net hours remain in shareholders' pockets. In high tax regimes, the ITYT still dwarfs bond coupons, proving that even after the taxman takes his share, Bitcoin protects more labor than the dividend portfolios ever could. So you could divide the raw ITY by downside deviation, focusing only on the volatility that keeps the CFOs awake at night. The astonishing finding is that the upside is power law distributed, so Sortina ITY stays decisively positive, while most assets collapse to parity once you penalize the left tail. You could map every S&P 500 sector's real return to see which corporate moats genuinely outpace inflation. Over the past decade, only energy producers and a handful of software firms occasionally surpassed a 50% ITY benchmark, while Bitcoin averaged more than 200. So boards are suddenly grasping that their risk-free rate is no longer the treasury yield, it is Bitcoin's time dividend. And these extensions turn ITY from a retrospective statistic into an operational dashboard. They let tax planners, risk managers, ESG committees, and even automated trading systems benchmark every dollar against the only metric that measures whether capital is compounding human time or surrendering it to entropy. And this is just the truth, kids. I'm telling you, every metric in finance chases a single goal: preserving human potential across years and generations. Implied time yield translates that mission into the language of minutes and hours regained each time Bitcoin outruns inflation. 16 years of data proves the pattern. Even after catastrophic drawdowns, Bitcoin has delivered an average ITY above 200%, while bonds, equities, and gold all struggle to reach the double digits in real terms. This is not a speculative anomaly, it is a structural outcome of absolute scarcity colliding with global demand. Whenever you allocate capital below Bitcoin's ITY, that means you volunteer to work extra months and years in the future to buy the same groceries, rent, or education. If you align with ITY, you compress decades of earning power into a few halving cycles, handing yourself and your shareholders the rarest assets on earth: free time. Treasury teams, pension boards, individual savers, the choice is no longer between risk and safety. It is between accepting slow confiscation or compounding temporal freedom. Benchmark every decision against implied time yield, and you will know in real time whether capital is buying you tomorrow or selling it back to the market at a discount. The clock is running. Let it work in your favor. Thank you so much for watching. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like this video, subscribe to the channel, and let me know what you'd like me to comment on next. Have a terrific day. Class dismissed.